we decided to take a look at something we don't usually look at on market measures, which is the relationship between a bunch of different asset classes. SPYs, which is the S&P 500. Let's think about it in bigger terms. Okay. Forget about SPY. S&P 500, US dollar, and bonds. We talk a lot about all of these because we trade all of these. I currently have lots of positions on in the US dollar, lots of positions on the S&Ps, and a bunch of positions on in bonds. So these are clearly a topic that we trade. We basically practice what we preach. Mm-hmm. So I think getting into a little more detail about how these are all related to one another is kind of something that's important and something that we don't talk about much. The first question I'll throw out to the bat is S&Ps, US dollar, and bonds. Yeah. We used to say bonds and the S&Ps were inversely
inverted. All my career, or most of my
career,
trading
except
career,
for the last 25 years, the last 20 years.
On the floor was an inverse relationship.
I got it. Meaning that stocks and bonds, they go different directions.
Stocks started selling off, markets was going higher.
Stocks go up, bonds go down. Stocks go down, bonds go up. Flight to quality.
They've been uncorrelated as far as I've been able to tell since then.
They've been non-correlated for the last 20 years. Almost. Since like 2008. 17 years. So basically, there hasn't been much correlation between stocks and bonds. Not at all. You want to throw the US dollar in there? There used to be a relationship between the US dollar, stocks, and bonds. But that relationship is essentially non-correlated now. Mm-hmm. So when you look at these three asset classes, it's almost impossible to say that if one does one thing, that the other one's going to do something else, or what the other one's going to do.
Yep.
The only thing we kind of know for sure is that when the S&Ps go up, volatility goes down. That's all we really know.
Yeah.
And when the S&Ps go down, volatility goes up. That we know for sure. That's never going to change. But how the S&Ps act related to the US dollar, or how the S&Ps act related to bonds, I don't think that's something you can figure out. I think that's something you have to respect when it happens. Let's go to the next slide. Back in April of 2025, we saw the simultaneous move down in equities and bonds while seeing a rally in the US dollar. Since then, we've seen bonds stay flat, equities go up, and the US dollar go down.
Yeah.
None of it makes any sense. If you're trying to...
Not if you're looking for correlation.
If you're trying to build some kind of a macro picture, none of it makes sense. This is what I love about this move, is that it totally threw Ilya and Chris off for a loop. Thinking from the perspective of correlations and long-term asset relationships, do these assets have a long-term price relationship, or is it the correlation between them spurious? Spurious, I meant. Let's go next slide.
Whatever you meant, doesn't really matter.
So, SPYs, TLT, and UUP. We used all the
UUP is a
ETFs.
Dollar index, right? US dollar.
Yeah. These are the S&P 500, the long bond, and the US dollar. We just use the ETFs instead because we have more data for the ETFs, and it lines up with everything else we do. So we took 10 years of data. We looked at the long-term correlation between these three assets, and we looked at the short-term correlation in a snapshot, and we're going to compare the results. Let's go next slide. So this is the 3-month correlation. And what's interesting here, well, first I'll read this and I'll explain. So when looking at the correlations the last 3 months, we see that surprisingly, the dollar and bonds have had a near zero correlation, while the dollar and SPY have had a more negative correlation than others. But the reality here is you couldn't look at these indexes and make a directional prediction.
No.
Okay. So when you start to look here, you look at UUP and TL, the dollar and bonds, a negative 0.2, the dollar and stocks, a negative 0.8. The stocks and the dollar, negative 0.3, and the stocks and bonds, a 0.08, which is basically nothing. So what you're looking at here is virtually no correlation, meaning that you can't predict. You can't say, oh, like here today, The US dollar is against the euro.
Up a little bit.
Oh, it's down. US dollar is down pretty good today versus the euro. The US dollar is down
UUP
600.
is up, though. The dollar index is up.
And bonds are up small and the S&Ps are up small. There's no way you could, it's not something that's predictable. Okay. Let's go next slide. Or bonds up today, stocks up today. Okay. With the SPY and the dollar having a more negative correlation than the others in the short term, we can't conclude this relationship is just temporary until we look at the long-term picture. How have the correlations between all three of these assets classes looked over time? Let's go to the next slide. So here, in general, the UUP, which is the US dollar, shows strong negative correlation with the SPY over 3 months, indicating dollar strength pressures short-term stocks. While in 10 years, TLT consistently showed negative correlations, particularly with UUP, making it a useful hedge against dollar strength. I'm going to question that
even
conclusion.
Those findings, right?
I'm going to question that last conclusion, that our research team made, because they're thinking that, okay, there's something that you can draw from this that's a tough one for me.
I mean, was this dollar hedge against stocks? I mean, that would be undoable in practical application. You're not going to get long or short UUP because your portfolio has long or short delta in it.
I don't think that looking at any of these, looking at 10-year price correlations or looking at 3-year price correlations.
I mean, this is a good to know type thing. I don't know how I can benefit financially from it.
I don't think you can. The way you benefit financially from it, there is a way. The way you benefit financially from what we're doing today.
Not listen to the headlines?
Is not listen to the headlines. Okay. They tell you, oh my God, the US dollar is dropping. So gold's going to be higher.
Right.
It's actually down $83. You know what I'm saying? Like, don't think. This is my whole argument. That's always been the argument about all these big, all this macro bullshit that people spew nonstop, because there is I want somebody to call people out on this. There is no way that you can see a lower or higher dollar and make a bond call. And there's no way that you can make a bond call that's going to impact what you're going to do in the stock market. You just cannot do it.
Yep.
So a lot of the chatter, okay, it's totally okay to say, hey, bonds are oversold here, just based on a completely objective view or subjective. I don't care what it is, but you can make that call just based on price action. But you can't make the call that bonds are going to go higher because stocks are necessarily going to go lower or higher, or the dollar is going to go lower or higher. Can't do it. There's nothing to support that. Let's go next slide. This is a good one. From 2020 to 2025, SPYs and the dollar have generally had an inverse correlation. Over longer horizons, however, there's no persistent long-term relationship between the US dollar and the equity marketplace. And you can see that right here. And they always just seem to get back to one way or another. Either the SPYs are rich or dollar, either SPYs are rich or the dollars are rich, but in this case, the dollar was rich and then SPYs are rich. But there's no play here. Let's go to the next slide. And for bonds in the dollar, they've seen the same inverse trend as equities in the dollar, but the day-to-day relationship between bonds and the US dollar is essentially non-existent now and in the past. It's just, there's nothing there. You can't trade off that. This is the key takeaway. It's not something that's tradable. And the reason that we talk about this like this is because if you want to trade the US dollar, go for it, man. It's been a good trade for us all year long. Long yen by being short puts and being short strangles in the euro has been a good trade. It's a good trade today.
Yep.
But don't think that you're going to be able to tell from what's going on in the bond market today, up 8 ticks, that you should be long or short US dollars. And don't think you can tell by being long or short US dollars whether or not you should be long or short S&P 500. Let's go to the last.
Well said.
So after researching the data we presented, we cannot conclude a long-term daily statistical relationship between bond stocks and the US dollar, as we've been saying all along. Even though equities and the dollar had a little more inverse relationship or inverse correlation in the last 3 months than others, looking at the history of 3-month correlations, it seems like this moment is statistically insignificant compared to the long-term averages.
Subject to change, Sosnoff.
Again, when it comes down to the world of investing, the more you know about trading from the trades that you make, the more valuable that is as potential wealth creation. It's not trying to figure out what's happening around the world.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.